Let's delve into the key performance indicators from Lemonade's Q1 2026 shareholder letter. Firstly, in-force premium stands at $1,333 million, marking an impressive 32% increase. This metric, representing the total premium revenue from active insurance policies, signifies a substantial expansion in Lemonade's business scale. Next, premium per customer averaged $424, a 7% rise from the previous quarter. This suggests that customers are opting for higher value products or that existing customer premiums have been adjusted upwards, indicating potential improvements in profitability. Lastly, total customers reached 3,142,581, demonstrating robust growth of 23%. This result reflects an expansion of Lemonade's market share and a rise in brand recognition. All three of these core indicators display positive growth, suggesting a very promising outlook for Lemonade's business. First, let's examine the in-force premium on the left chart. We can see a positive trend, starting from $794 million in Q1 24, increasing to $1,008 million in Q1 25, and further rising to $1,333 million in Q1 26. This indicates a consistent expansion of business scale, suggesting robust growth drivers. Next, looking at the key metrics bar chart on the right, GEP, gross earned premium, significantly increased from $188 million in Q1 24 to $306 million in Q1 26. Concurrently, Adjusted EBITDA slightly decreased from -$34 million in Q1 24 to -$36 million in Q1 26, and net loss also increased from -$17 million in Q1 24 to -$36 million in Q1 26. It's particularly noteworthy that the net loss/GEP ratio decreased from 25% in Q1 24 to 12% in Q1 26. This demonstrates that losses are decreasing relative to revenue growth, hinting at potential profitability improvements. Overall, while revenue is growing strongly, efforts to improve profit margins will become increasingly crucial. Let's first examine the changes in gross profit and gross profit margin through the chart on the left. Gross profit has increased from $35 million to $39 million, which can be interpreted as a positive sign. However, the gross profit margin, after declining from 29% to 26%, has sharply rebounded to 39%. The surge in gross profit to $100 million in the most recent quarter, driving the margin up to 39%, is particularly noteworthy. This suggests either effective management of cost of goods sold or an increased contribution from high-margin products or services. The chart on the right displays adjusted free cash flow and cash flow from operating activities. Both indicators were negative prior to the most recent quarter, indicating challenges in cash generation. However, in the latest quarter, adjusted free cash flow turned positive at $17 million, and the negative cash flow from operating activities significantly narrowed to $1 million. This signifies an improvement in the company's financial health and its growing ability to generate cash from operations. The sharp rise in gross profit margin coupled with the positive shift in free cash flow is expected to positively impact the company's future growth potential and profitability. Dear shareholders, our first quarter results were excellent, marked once again by top-line growth acceleration, healthy underwriting performance, and strong operating leverage. We've made steady progress towards our first Adjusted EBITDA positive quarter, a trend we expect to continue through Q4 2026. Let's review the key metrics for Q1. The top line reached $1.33 billion, with in-force premium growing 32%, extending our streak of IFP growth rate acceleration to 10 consecutive quarters. Revenue grew even faster, up 71% to $258 million, reflecting the impact of our recent reinsurance transition and higher premium retention. Gross profit increased significantly by 159% year-over-year to $100 million. On the bottom line, the adjusted EBITDA loss was $17 million, a 64% improvement year-over-year, while the net loss for the quarter was $36 million, a 43% improvement. Regarding cash flow, adjusted free cash flow was $17 million, an improvement of $48 million year-over-year, and cash flow from operations was roughly break-even at $47 million, also an improvement. Notably, there has been significant investor interest in our AI capabilities, specifically concerning their competitive standing within the rapidly evolving AI landscape. Daniel recently shared more detailed thoughts on this topic in our blog, which is linked for your reference. This chart illustrates IFP versus employee count, comparing revenue per employee against the number of employees. According to the text on the left, the company has scaled its operations by integrating LLMs into its technology stack since the launch of ChatGPT in late 2022. As a result, by the first quarter of 2023, IFP per employee surpassed $1 million. This represents a more than twofold increase in IFP compared to the fourth quarter of 2022, while simultaneously reducing team size by 6%. AI-powered automation has enabled the company to secure team capacity that supports accelerating growth and simultaneously delivers improved customer support quality without adding headcount. Observing the graph, the employee count, represented by the gray line, shows a slight decrease or stabilization from 1,367 employees in Q4 2022 to 1,291 employees in Q1 2026. In contrast, IFP per employee, indicated by the pink line, demonstrates a sharp increase from $625 million in Q4 2022 to $1,333 million in Q1 2026. These figures clearly indicate that the company is maximizing workforce efficiency while significantly boosting revenue. This chart illustrates the relationship between the LTV/CAC ratio and growth spend. In Q1 23, growth spend was $17 million with an LTV/CAC ratio of 3x. By Q1 26, growth spend increased to $54 million, approximately a 200% rise, while the LTV/CAC ratio remained steady at 3x. This defies conventional wisdom, indicating that efficiency is being maintained or improved even as growth spend escalates. This achievement is attributed to our AI-powered growth engine and proprietary LTV model, which enable real-time optimization of targeting and capital allocation. Furthermore, an increasingly diverse channel mix and higher LTV from bundling are supporting this trend. This slide, titled Pet Crosses $500 million IFP, summarizes the performance of a specific product, reaching approximately $500 million in annualized premium. This product marks a significant milestone as the first in our portfolio to achieve this level within 6 years of its launch. It has rapidly scaled to become the #1 most searched pet insurance brand in the U.S. and the 4th largest carrier by written premium. This rapid ascent is attributed to a set of structural advantages. Firstly, our AI-powered automation drives LA ratios of around 4%, providing a structural cost advantage over peers. This creates margin headroom and enhances our flexibility to price competitively while maintaining attractive unit economics. Secondly, our proprietary AI-powered pricing engine is believed to offer a precise match rate to risk compared to peers. Thirdly, with AI-powered automation across most support and claims interactions, we deliver fast, seamless customer experiences at scale. Finally, we've built a diversified distribution model beyond the traditional vet channel, combining direct-to-consumer and partnerships channels to expand reach. This is complemented by CAC-free cross-sales to existing customers, which currently account for approximately $85 million of pet IFP. As illustrated in the chart, our loss ratios are comparable with peers, during periods in which we took notably less rate. This positions our business for growth that is more than 3x faster than the industry. Specifically in Lamonade Pet for 2025, the rate change is 12%, lower than the industry average of 27%, yet the gross loss ratio excluding LA stands at 66%, outperforming the industry average of 68%. Furthermore, the IFP growth rate is a remarkable 55%, significantly exceeding the industry average of 17%. This indicates both cost-effective operations and strong growth drivers. In addition, the Lemonade car segment continues to demonstrate strong momentum. The IFP growing 60% year-over-year represents our fastest growth rate to date, a significant acceleration compared to the 9% IFP growth a year ago. This is while delivering healthy underwriting performance with a 74% gross loss ratio. These metrics clearly demonstrate that each of Lemonade's business segments is successfully competing in the market. This chart displays the car IFP YOY growth rate, indicating the year-over-year percentage increase for car IFP. As observed in the graph, the growth rate began at an initial 3%, steadily climbed to 7%, then 9%, and subsequently reached 22%. More notably, the growth accelerated thereafter, achieving 39% and 53%, and has now reached 60%. This signifies that the growth in the automotive business segment is occurring very robustly across the board. Furthermore, the text explains that recently launched states, such as Colorado, have experienced rapid growth, becoming the fourth largest state by car IFP share. In particular, new business in both direct-to-consumer and cross-sale channels is growing rapidly at over 100% year-over-year, reflecting strong demand and continued expansion within the existing customer base. Therefore, this positive growth trend suggests a bright outlook for future business performance. From an underwriting perspective, we are continuing to see encouraging trends across both new and renewal loss ratios over several quarters, even as growth has accelerated. Taken together, these trends reinforce our confidence in the business. Furthermore, we are pleased to announce that our upcoming Investor Day will take place in New York City on November 17th at 9 a.m. More details will follow closer to the event, and we hope to see many of you there. Finally, regarding guidance, we are providing our view on how we expect the second quarter and full year 2026 to shape up. Our guidance reflects improved FY26 ranges for IFP, GEP, revenue, and ADJ. EBITDA as compared to prior guidance, and indicates FY26 IFP growth of 33%. We continue to reiterate our expectation that we'll deliver positive ADJ. EBITDA. This slide presents the company's key financial metrics for Q2 2026 and the full year outlook. First, the in-force premium is projected to be between $1.428 billion and $1.433 billion for the second quarter, and between $1.632 billion and $1.639 billion for the full year. This indicates a steady increase in the scale of insurance policies managed by the company. Gross earned premium is forecasted to range from $328 million to $331 million in Q2, and from $1.369 billion to $1.373 billion for the full year, suggesting stable growth in premium revenue. Revenue is expected to be between $287 million and $290 million for Q2, and between $1.197 billion and $1.203 billion for the full year, reflecting positive revenue growth. A particularly noteworthy item is the adjusted EBITDA loss, which is projected at a loss of $19 million to $23 million for Q2, and $47 million to $51 million for the full year. While the trend of decreasing loss is positive, it highlights that profitability improvement remains a key challenge. Finally, stock-based compensation expense is $24 million with a weighted average of 77 million common shares outstanding, and for the full year, these figures are $95 million and 78 million shares, respectively. These financial projections showcase the company's growth potential alongside its efforts to enhance profitability, making it crucial for investors to closely monitor these trends. Let's review the key performance indicators for Q1 2026. First, the in-force premium, which represents the total annualized premium for active policies, reached $1.33 billion, marking a significant 32% increase compared to Q1 2025. This suggests growth in our customer base coupled with potential premium increases for existing customers. Next, customers. The customer count rose to 3,142,581, an increase of 23% from Q1 2025. This indicates that aggressive new customer acquisition strategies are proving effective. Based on these two metrics, the premium per customer, which is the average premium per customer, stands at $424, up 7% from Q1 2025. This is a very positive sign, demonstrating not only an increase in customer numbers but also a rise in value per customer. Finally, annual dollar retention is mentioned, though specific figures are not provided, indicating a need for further information. Overall, these indicators clearly highlight the company's robust growth trajectory and increasing customer loyalty. ADR, defined as the percentage of IFP retained over a 12-month period, inclusive of changes in policy value, changes in the number of policies, changes in policy type, and churn, stood at 85%. This represents a 1 percentage point increase compared to the first quarter of 2025, and it remained flat from the fourth quarter of 2025. Furthermore, the first quarter's gross earned premium amounted to $306.2 million, marking an increase of $72.6 million, or 31%, when compared to the first quarter of 2025. This growth is primarily attributed to an increase in IFP earned during the quarter. These figures indicate a stable and growing business operation. Let's begin by examining the revenue. First quarter revenue reached $258.0 million, marking an increase of $106.8 million, or 71%, compared to the first quarter of the previous year. This growth was primarily driven by an increase in gross earned premium and a higher premium retention rate, resulting from reduced quota share cession rates that became effective in the third quarter of 2025. Moving on to gross profit, the first quarter gross profit stood at $100.1 million, an impressive increase of $61.5 million, or 159% year-over-year. This surge is largely attributable to a 71% increase in revenue, coupled with a 19 percentage point improvement in the net loss ratio, attributed to enhanced underwriting results and the impact of the California wildfires in the first quarter of 2025. Finally, adjusted gross profit for the first quarter was $100.8 million, up by $54.8 million, or 119%, compared to the same period last year. This increase is primarily due to the 71% rise in revenue and a 19 percentage point improvement in the net loss ratio, stemming from improved underwriting results and the impact of the California wildfires in the first quarter of 2025. It's important to note that adjusted gross profit is a non-GAAP measure. Total operating expense, excluding net loss and loss adjustment expense, stands at $159.3 million, marking a 25% increase of $32.1 million compared to the first quarter of 2025. This rise is primarily attributed to higher growth spending aimed at customer acquisition. Specifically, growth spend, which is part of sales and marketing expenses, amounted to $54.3 million in the current quarter, up from $38.1 million in the first quarter of 2025. The net loss for the first quarter was $35.8 million, or 47 cents per share, a notable improvement from the $62.4 million, or 86 cents per share, recorded in the first quarter of 2025. Furthermore, the adjusted EBITDA loss was $17.1 million, significantly better than the $47.0 million adjusted EBITDA loss in the first quarter of 2025. The year-over-year improvement in adjusted EBITDA is mainly driven by revenue growth and enhanced underwriting results, though it was partially offset by increased growth expenditures. It is important to note that adjusted EBITDA is a non-GAAP measure. This slide covers the company's cash and investments, as well as its adjusted free cash flow. As of March 31, 2026, the company held a total of $1.14 billion in cash, cash equivalents, and investments. Additionally, there is a requirement to hold approximately $290 million of regulatory surplus at its insurance subsidiaries. Looking at a key metric, adjusted free cash flow for the first quarter was $17.4 million, a significant improvement from the negative $31.0 million recorded in the first quarter of the prior year. This positive shift indicates an enhancement in the company's financial health, which can be interpreted as a very favorable sign for investors. Reconciliations of GAAP to non-GAAP financial measures, along with definitions for the non-GAAP financial measures and the reasons for their use, are presented at the end of the letter. This table presents a comparison of key operating and financial metrics for the 3 months ended March 31, 2026, versus the same period in 2025. Firstly, customer count has significantly increased from 2,545,496 in 2025 to 3,142,581 in 2026, indicating robust business expansion. The in-force premium also rose from $1,007.8 million to $1,333.2 million. The premium per customer increased from $396 to $424, and the annual dollar retention improved slightly from 84% to 85%. Total revenue saw a substantial jump from $151.2 million to $258.0 million, a natural consequence of the growth in customer numbers and premiums. Gross earned premium grew from $233.6 million to $306.2 million. However, gross profit itself experienced significant growth, rising from $38.6 million to $100.1 million, while adjusted gross profit also showed remarkable growth from $46.0 million to $100.8 million. Notably, the net loss significantly improved from a loss of $62.4 million in 2025 to a loss of $35.8 million in 2026. Adjusted EBITDA also showed considerable improvement, moving from a loss of $47.0 million to a loss of $17.1 million. Examining profitability metrics, the gross profit margin improved from 26% to 39%, and the adjusted gross profit margin rose from 30% to 39%. The ratio of adjusted gross profit to gross earned premium increased from 20% to 33%, indicating enhanced profitability generation. Conversely, the gross loss ratio decreased substantially from 78% to 62%, and the net loss ratio also declined significantly from 82% to 63%. Overall, the first quarter of 2026 demonstrates strong growth across nearly all metrics compared to the same period in 2025, including customer count, revenue, and profitability, with the significant reduction in the scale of losses being a particularly positive indicator. Let's analyze the chart displaying 3 key metrics: customers, premium per customer, and in-force premium. The first chart, customers, shows a consistent upward trend from 2,095 in Q1 2024 to 2,545 in Q1 2025, and further to 3,143 in Q1 2026, indicating successful expansion of the customer base. Notably, growth rates of 21% and 23% were observed between Q1 2025 and Q1 2026 respectively. The second chart, premium per customer, increased from $379 in Q1 2024 to $396 in Q1 2025, and then to $424 in Q1 2026. This suggests customers are opting for higher value products or experiencing premium increases, with growth rates of 4% and 7% in Q1 2025 and Q1 2026, respectively, demonstrating positive momentum. Finally, in-force premium saw a substantial rise from $794 million in Q1 2024 to $1,008 million in Q1 2025, and then to $1,333 million in Q1 2026. This is a combined result of the increasing customer base and premium per customer, showing very strong growth rates of 27% and 32% in Q1 2025 and Q1 2026, respectively. These metrics strongly suggest the company's sustained growth and potential for profitability improvement. Let's examine two key metrics: gross earned premium or GEP, and revenue over time. Firstly, GEP increased from $187.9 million in Q1 2024 to $233.6 million in Q1 2025, a 24% rise, and continued its robust growth to $306.2 million in Q1 2026, marking a 31% increase. This indicates a steady rise in premium income, and the acceleration in growth rate in Q1 2026 compared to the previous period is particularly noteworthy. Next, looking at revenue, it grew by 27% from $119.1 million in Q1 2024 to $151.2 million in Q1 2025. Furthermore, it reached $258.0 million in Q1 2026, achieving an explosive growth rate of 71%. Both GEP and revenue show an accelerating growth trend in Q1 2026, and the fact that the revenue growth rate is outperforming the GEP growth rate strongly suggests improving profitability for this company. These figures provide a significant basis for a positive outlook on the company's future financial performance. This chart illustrates the company's trends in gross profit and gross profit margin. Looking at the bar graph on the left, gross profit increased from $34.7 million in Q1 2024 to $38.6 million in Q1 2025, an 11% rise. Notably, in Q1 2026, it surged to $100.1 million, marking an explosive 159% year-over-year growth. Concurrently, the line graph on the right shows the gross profit margin trend. After a slight dip from 29% in Q1 2024 to 26% in Q1 2025, it significantly rebounded to 39% in Q1 2026. The simultaneous rise in both gross profit and the profitability metric, gross profit margin, is a very positive sign. This suggests improved cost control, higher selling prices, or an increase in the sales mix of high-margin products, indicating efficient operational performance. This trend is expected to be a strong driver for the company's continued profitability moving forward. The bar graph on the left displays the adjusted gross profit on a quarterly basis. It increased by 25% from $36.7 billion in Q1 2024 to $46.0 billion in Q1 2025. And then recorded an explosive growth rate of 119% to $100.8 billion in Q1 2026. This indicates significant achievements not only in revenue growth but also in cost control. The graph on the right shows the ratio of this adjusted gross profit to GEP, gross economic product. This ratio remained constant at 20% in both Q1 2024 and Q1 2025. But significantly rose to 33% in Q1 2026. The improvement in profitability ratio relative to GEP, along with the growth in adjusted gross profit itself, is a very positive sign, demonstrating enhanced earnings generation capability of the company. This trend is likely to have a positive impact on the stock price in the future. This bar chart illustrates the company's operating expense trends from Q1 2024 to Q1 2026. Total operating expenses show a consistent upward trend, increasing from $98.4 million in Q1 2024 to $127.2 million in Q1 2025, and further to $159.3 million in Q1 2026. Each quarter's expenses are primarily broken down into general and administrative, technology development, other insurance expense, and sales and marketing. Notably, sales and marketing expenses represent the largest portion throughout the period, with its absolute value also continuously rising. This suggests the company is investing heavily in aggressive marketing and sales activities for business expansion. While this increase in operating expenses can be viewed positively if it translates into revenue growth, close monitoring of future cost control and profitability improvement is essential. Let's first examine the net loss trend. The leftmost bar shows a net loss of $47.3 billion, which decreased to $35.8 billion in the following quarter, a 32% reduction. This can be interpreted as a positive signal of shrinking losses. Next, looking at the adjusted EBITDA, it shows a remarkable improvement of 64%, turning from a loss of $47.0 billion in the previous quarter to a profit of $17.1 billion in the current quarter. This, along with a 39% reduction in the loss margin, indicates a significant recovery in the company's profitability. These financial performances can also impact the trends in total cash and investments, serving as crucial indicators for assessing the company's financial health going forward. Let's examine the trend in adjusted free cash flow. It began at $996 million in Q1 25, steadily increasing to $1,032 million in Q2 25 and $1,061 million in Q3 25. The cash flow rose to $1,120 million in Q4 25, and in the most recent quarter, Q1 26, it reached $1,138 million. This clearly demonstrates 5 consecutive quarters of consistent free cash flow growth, a very positive indicator. Looking at the quarter-over-quarter growth rates, we see approximately a 3.6% increase from Q1 25 to Q2 25, about 2.8% from Q2 25 to Q3 25, a significant 5.6% jump from Q3 25 to Q4 25, and a 1.6% rise from Q4 25 to Q1 26. This sustained increase in cash flow suggests strengthening financial health and enhanced capacity for business expansion, which is expected to positively impact future shareholder value and further investment decisions. Here, we will examine the loss ratios for the insurance segment in detail on a quarterly basis. Looking at the overall trend, the gross loss ratio showed a clear downward trend, decreasing from 78% in Q1 25 to 52% in Q4 25, suggesting an improvement in the insurer's profitability. Notably, the loss ratio excluding catastrophe losses, CAT, and loss adjustment expenses, LA, also consistently decreased, indicating an overall improvement in operational efficiency rather than specific event impacts. Furthermore, the reduction in the impact of prior period development, PPD, has driven the decline in the gross loss ratio. The decreasing or negative impact of PPD on a quarterly basis signifies that past losses were less than anticipated or managed more efficiently. Finally, examining the loss ratios by product type, auto insurance showed a significant improvement from 88% to 74%. However, products in the Europe region and homeowners insurance exhibited relatively higher volatility or slight increases. This suggests that additional management or strategic adjustments may be necessary for specific markets or product lines. Next, let's examine the key performance indicators for insurance companies. Firstly, the gross loss ratio is the ratio of total losses and loss adjustment expenses to gross earned premiums, expressed as a percentage, measuring the fundamental profitability and soundness of an insurer. The gross loss ratio ex-CAT excludes catastrophe losses, providing a more precise assessment of general loss management capabilities. The TTM gross loss ratio represents the ratio of total losses and loss adjustment expenses over the trailing 12 months to the gross earned premiums during the same period, useful for understanding recent profitability trends. The net loss ratio indicates the ratio of losses to net earned premiums, after excluding premiums ceded to reinsurers, reflecting the losses actually borne by the insurer. Finally, the attritional gross loss ratio is the ratio of gross losses, excluding catastrophe losses and prior period development, PPD, to gross earned premiums, serving as an indicator to analyze loss ratios resulting from everyday claim occurrences. These various loss ratio indicators are essential for a multifaceted understanding of an insurer's profitability and risk management capabilities.